Welcome to this webinar covering some key changes to UK GAAP for periods commencing after the 1st of January 2026. I'm Miriam Hanley. I'm an Audit Director in our Woking office.
I'm Bayan Aliar. I'm a Senior Manager within our technical team at Menzies.
I'm Mita Chan. I'm a Director based in the London office.
So in terms of the agenda for today's session, we're going to start with an update on what the new requirements to UK GAAP are, followed by more practical considerations on how best to prepare for some of the more significant amendments to both revenue recognition and lease accounting. In terms of the FRC periodic review, so the FRC carry out periodic reviews approximately every 5 years. And as part of those reviews, they look at the existing standards, so FRS 102, FRS 102.1a, and FRS 105, and they think about how best to improve upon them. Now, the latest periodic review was published back in March of last year, and it's the second periodic review that the FRC have carried out. Now, as part of this latest periodic review, we have the two headline changes, as I mentioned, to both revenue recognition and lease accounting to bring them more in line with the current accounting standards under IFRS. Now, there are some more minor amendments as part of the update to things like enhanced disclosures for small company reporting and further guidance on how best to determine fair value. But in today's webinar, we're just going to be focusing on those two headline changes, as those are expected to have the biggest impact on the financial statements. Now, as Miriam mentioned, the effective date for these changes is periods commencing 1st of January 2026. So that's your December 2026 year ends onwards. Now, there is an option to early adopt, provided that all the amendments are applied at the same time. So you can't cherry pick, it's very much an all or nothing approach. Now, you may want to early adopt if, for example, EBITDA is something that as a company you focus on, because as Namita will explain in a moment, the changes to lease accounting will increase EBITDA. Or you may want to early adopt if for group reporting purposes, you already are reporting under IFRS, and therefore by early adopting, you're bringing your financial statements more in line with IFRS at an earlier date. Now, the FRC's aim with these periodic reviews is really to enhance quality and reporting in the UK, to provide users of the accounts with more useful information. But not only that, it's about providing greater consistency with IFRS, which in turn will reduce gap differences and provide greater comparability across company reporting in the UK. So starting with lease accounting then. So these changes to lease accounting is applicable for entities reporting under FRS 102 and for small entities reporting under FRS 102.1a. Now, this new lease accounting model that is introduced is based on principles under IFRS 16. So it removes that distinction between operating leases versus finance leases for lessees. For lessors, there's very minimal changes as part of this periodic review, and you pretty much carry on accounting for your leases as you would do under the current standard under FRS 102. But for lessees, there's a whole new accounting model in which virtually all leases will end up on balance sheet and be accounted for in a similar way as you would do with your finance leases. So what you'll have if you're a lessee entering into a lease under this new periodic review change is you'll recognise a lease liability on your balance sheet, and that will represent your obligation to make payments to the lessor. And you're going to be recognising a corresponding right of use asset, representing your right to use the underlying asset of the lessor. Where under current FRS 102 for operating leases, you'll have an operating expense charge going through the P&L. This will now be replaced with an interest charge on your lease liability, which will be higher in the earlier years of the lease, and you'll have a depreciation charge on your right of use asset. So as I mentioned, this is a big change in which virtually all leases will now end up on balance sheet, with the exception of short-term leases and leases of low value assets. So what do we mean by short-term leases? So those are those leases that from the commencement date have 12 months or less to run. Now, the FRC are quite prescriptive in terms of what meets the definition of short-term and what doesn't. So, for example, it can't apply to leases which contain a purchase option within them, Or where you have an 8-year lease, for example, but you have break clauses at each 12-month point. Again, that isn't meeting the definition of a short-term lease. For leases of low value assets, however, it's a lot more open to interpretation. So the FRC don't actually provide a financial threshold as to what is low value and what isn't, and it isn't linked to materiality. Instead, what they do provide is a series of examples of what isn't low value. So some of these are quite obvious, but it does include things like cars and vans, so those can't be treated as low value assets. One thing to watch out for here is if you have an asset that individually is low value, but it's highly interrelated with other assets in order for it to work, then again, that doesn't meet the definition of a low value asset. So this is going to require a bit of judgment as to what meets that definition and what doesn't. In terms of initial application on transition to the new leasing accounting amendments, you don't restate your comparatives. So it's different to IFRS 16 in this respect. Under IFRS 16, there was a choice in this matter, but under this new lease accounting model, the changes to FRS 102 and FRS 102.1a, there isn't a choice. So you don't restate comparatives. Instead, you recognise the cumulative effect of transitioning to the new lease accounting model as an adjustment to your opening retained earnings at the date of initial application. So what do we mean by the date of initial application? That's your first day of your relevant accounting period. So at that date of initial application, as a lessee, you're going to be recognising a lease liability, which is the present value of your remaining future lease payments, and you're going to be recognising a corresponding right of use asset. Now, the key thing here is you're looking at your future lease payments. You aren't going back to the very start of the lease and bringing in all those payments prior. It's only looking at the initial application date and onwards and all those lease payments after that point. Now, there is a practical option for where you, for group reporting purposes, already produce numbers to report under IFRS 16 for group reporting. There is a practical option to use those calculations as a starting point on your transition to the new lease accounting model at the date of initial application. So that's a very high level overview of leases. I'm now going to hand over to Mita to provide a little bit more detail on this.
Now let's look at the requirements for how to calculate the lease term. The lease term is the non-cancelable period of the lease. For example, if you have a 10-year lease and a break clause that you are reasonably certain to exercise after 5 years, then you should calculate the lease term as being the 5-year non-cancelable period. Similarly, if you have the right to extend the lease and you're reasonably certain to do so, you should include the extended period in your lease term. Now, what does reasonably certain mean? Well, that's a matter of judgment. You will need to discount the unpaid lease payments to present value to determine the value of the right of use asset and lease liability. Now, how do you choose a discount rate? Well, the standard says that if you have an interest rate at the inception of the lease that causes the present value of the lease payments to equal the fair value of the leased asset, and this rate is readily available, you must use this rate. This rate is referred to the rate implicit in the lease. Now, this is effectively the rate of return on the asset, and in practice, you're unlikely to have this information unless it's been provided to you by the lessor. So that leaves a choice between two options, the incremental borrowing rate and the obtainable borrowing rate. The incremental borrowing rate is the rate that at inception of the lease, the lessee would have to pay to borrow funds necessary to purchase a similar asset over a similar term with similar security. Now, that rate is quite complex because it's a secured rate, and the rate depends on the nature and monetary value of the asset being leased. Luckily, we've been given a simplification in the form of the obtainable borrowing rate. The obtainable borrowing rate is the rate of interest a lessee would have to pay to borrow over a similar term, an amount similar to the total value of the lease payments undiscounted. Now, broadly speaking, this is the most straightforward option, and hopefully, in theory, it's easier to obtain this rate from your bank or another lender than it is for you to work out the other two rates. Now let's look at impact on KPIs. The EBITDA will go up because the rent charge is no longer in the P&L and it is being replaced by a finance cost and a depreciation charge, which means it could potentially impact on covenants as well. Gross assets will go up because of the right of use asset being brought into the accounts, and this could affect whether a company is breaching the company size thresholds for the purposes of the reporting requirements and the audit requirements. So whether a company is moving from small to medium or medium to large. And it's also worth noting that net current assets will fall because whilst you're bringing an asset onto the balance sheet, it's a fixed asset, not a current asset. And now we have a new short-term liability that we didn't have before. Now let's move on to the tax impact of lease accounting. We do think that HMRC will release guidance on this later on this year, but it is our expectation that the tax treatment will follow the accounting treatment. So for those companies that report under IFRS where leases are already on balance sheets, the depreciation of the right of use asset is treated as if it's a depreciation of a finance leased asset, and that doesn't get added back in the tax computation. As the tax treatment is likely to follow the accounting treatment, there will not be any deferred tax consequences as a result of that. Our tips for implementation. Well, we do think that implementing the new lease accounting requirements will be a challenge, particularly because there are those grey areas and areas of judgment. And one example of that is whether a contract contains a lease within the definitions of the standard. An example of this, a situation where this might not be straightforward, is if you had a contract to rent an office space and the contract specifies that the supplier can substitute that office space with an alternative office space, and they have alternative spaces available for you to use. It is practical for them to do so, it is beneficial for them to do so, and they are likely to do so, then do you actually have a right to control how and for what purpose that office space is used? And therefore, does that contract actually meet the definition of a lease? As we saw earlier, there will be judgments over determining the discount rate, but hopefully the option to choose an obtainable borrowing rate will simplify that decision somewhat. Do make sure you are managing the expectations of your key stakeholders, your banks, your lenders. Make them aware of the potential impact on your financial statements as early as you can. And another thing to be mindful of is if you are a parent company preparing group accounts under FRS 102 with subsidiaries in foreign jurisdictions that don't have leases on their balance sheets or they're accounted for in a different way, you'll need to carry out some transition adjustments when you prepare your group accounts, and that means you'll need to collect information on those leases as well. Looking at the impact on the IT systems, if you have lots of leases, you might decide to choose a piece of software to help you with those calculations. Or you might simply decide to use a spreadsheet and you'll need to make sure that you have the correct formulas in your spreadsheet to be able to do those calculations. Now, in terms of our tips for implementation, start going through your contracts and identifying those leases. Look through the terms and conditions and start picking out the facts and information that you'll need to do your calculations. And reach out to us with any queries as early as possible. In many cases, you probably don't even need to wait until after the year end to do your calculations, and that means that queries can be resolved ahead of your audit timetable or the timetable for preparing your accounts. And also, just to reiterate the point on monitoring any potential impacts of lease accounting on loan covenants or borrowing covenants.
Thanks, Namita. So moving on to the next headline change of revenue recognition. So this is applicable to entities reporting under FRS 102, small entities reporting under FRS 102(1)A, and for micro entities reporting under FRS 105. And this change to revenue recognition is based upon principles under IFRS 15. So it introduces a 5-step model, which you may or may not be already familiar with under IFRS 15. Now, Miriam will be going into a bit more detail as to the 5 steps and providing an example in these areas. But just to give you an overview as to what these 5 steps are. So step 1 is potentially the easiest step of the 5. It's all about identifying the contract you have with your customers. The key thing to remember here, though, is the contract doesn't need to be written. It could be verbal or it could be implied by normal business practices. Step 2 is potentially the most trickiest step of the 5. It's identifying the performance obligations in the contract. So performance obligations are those promises to provide goods or services to the customer within a contract. So you could have a contract that has multiple performance obligations within it. Step 3 is determining the transaction price. So that's the consideration you expect to receive in return for providing those goods or services to the customer as part of that contract. Now, this could be relatively straightforward if you've got a fixed transaction price, but be careful because it does include things like variable amounts, discounts, and non-cash consideration, which can be quite tricky at this step in terms of determining the transaction price. Step 4 is all about allocating the transaction price that you've determined in step 3 against the performance obligations in the contract that you've identified in step 2. And finally, step 5 is recognizing revenue when or as the entity satisfies a performance obligation. So it could be over time or it could be at a point in time. Now, these 5 steps are quite complex and they're very different to what we've seen under the existing standard for FRS 102. Under the existing standard, there's a series of examples, and based on our own individual client circumstances, we have to apply those examples as best as we can to our individual circumstances to come up with a solution as to how we're recognizing revenue. Under these 5 steps, although the steps individually are quite complex, once we've got to the end of the steps, it'll be very clear as to when or how we're recognizing our revenue. Now, in terms of the impact on different industries, this is going to vary very much on an industry by industry basis. But the key thing I want to stress here is, regardless of the end result and regardless or as if there is any change or not in your revenue recognition, you still need to have gone through the 5 steps to determine that. So it might be that you have a simple retail or hospitality company that once you've gone through the 5 steps, there's no change in how you should be recognizing your revenue. But even so, regardless of that, you still need to have shown and demonstrated how you've gone through the 5 steps to reach that conclusion. For industries such as manufacturing and construction, in terms of the change and the impact on this new revenue recognition model, this is going to really vary and it's going to be very dependent on performance obligations within the contract with the customers. Or, for example, if you have very, very bespoke contracts with individual customers, or whether you have standardized contracts with lots of customers as to how much you'll see a change in your revenue recognition. For technology and software licensing companies, it's expected that there is going to be a lot of change in your revenue recognition once you've gone through those 5 individual steps. So in terms of initial application on transition to the new revenue recognition model, for entities reporting under FRS 102 and small entities reporting under FRS 102(1)A, there is in fact a choice as to how you will apply this on initial application. So you could either go through the fully retrospective approach, in which you are going to restate your comparatives and act as if this has always been the case and this standard is always applied. Or you could do the modified retrospective approach, which is similar to what we've seen in leases, which is where you're going to recognise the cumulative effect of transitioning to the new revenue recognition model for any incomplete contracts at the date of initial application as an adjustment to your opening retained earnings. For FRS 105, so for micro entities, it's much more straightforward. So it's very much a prospective approach only. So you're only interested in contracts that have been entered into on or after the date of initial application. So that's a high-level overview on revenue recognition. I'm now going to hand over to Miriam to provide a bit more detail in these areas.
Thank you, Bayan. As Bayan briefly covered, the first step out of the 5 is identifying the contract. I won't go into any further detail on this step as it's the most straightforward of all the steps. The only thing I will say, contract does not mean there has to be something in writing. A contract can be oral, written, or implied by the parties' actions. What matters is that the criteria for a contract under the standards are met rather than the format of the agreement. So step 1 is identifying the contract with the customer. Step 2 is identifying the performance obligations. In this step, you need to identify how many performance obligations there are within a contract. But what is a performance obligation? Performance obligations are promises in a contract to transfer distinct goods or services to a customer. The key word is distinct. A good or service is distinct if it meets two separate criteria. These are the good or service can benefit the customer on its own or together with other readily available resources. And the second is that the good or service is distinct within the context of the contract. If a good or service is not distinct, then you combine it into a single performance obligation. The best way to explain what a performance obligation is through an example. So if we have a software company, say it's called Entity B, which enters into a contract to provide its customer with a software license, installation, and ongoing updates and technical support for the next 4 years. How many performance obligations are there within this contract? So some key bits of information to know when determining how many performance obligations there are is that each of these elements are sold separately. Installation can be performed by other parties without any issue, and the software remains functional without the updates. So the questions you have to ask yourself to determine how many performance obligations there are is whether the separate elements in this contract are capable of being distinct. So can the customer benefit from each of these promises on its own or along with other readily available resources? And the next question to ask yourself, are each of these different elements distinct in the context of the contract? So that means, are the goods or services highly interdependent, interrelated, or does the supplier provide a significant service of integrating the goods or services? So in this example, we have concluded that there would be 4 performance obligations. So you've got the software license, which would be a separate performance obligation. As soon as the customer receives the software license, they can benefit from that without any of the other elements in the contract. The installation, the fact that can be performed by any company, would indicate there's no level of customization, which would then indicate that the installation is a separate performance obligation. The ongoing updates, so the fact that this software remains functional without the ongoing updates would indicate that that is a separate performance obligation because it's actually enhancing the current benefit that can be obtained from the license. And finally, the technical support for the next 4 years, that could potentially be provided by another company, but also you can benefit from the technical support with the other resources that they have available. So in this scenario, there would be 4 performance obligations. Another classic example you often seen talked about when you look at the changes to the revenue standard is the mobile phone company. So at the moment, if you have a mobile phone company that has a contract with a customer that includes the mobile phone and then the telecommunication services, that contract, the revenue from that contract would be spread over the life of the contract. Now, when the changes come into place for the UK GAAP for periods commencing after the 1st of January 2026, you would look at the number of performance obligations within that contract. You'd conclude that there are 2 performance obligations, which is the mobile phone and then the telecommunication services, and you'd recognise them separately, with the mobile phone being recognised at a point in time, so when it's transferred to the customer, and then the telecommunication services would be spread over the life of the contract. That's one area where there will be significant changes. So step 2 was determining the number of performance obligations within a contract. So the next step, step 3, is determining the transaction price. So the transaction price is the amount of consideration to which the company expects to be entitled to in exchange for transferring promised goods or services to a customer. One of the more challenging areas of determining the transaction price is when there is variable consideration. So variable consideration is any element of the transaction price which varies according with uncertain future events. So that would include things such as discounts, rebates, refunds, or bonuses. So when there is variable consideration, that should only be included in the transaction price if it is highly probable that a significant reversal of the revenue will not occur when the uncertainty is resolved. Highly probable means more likely than not. That's the first judgment that needs to be made in relation to variable consideration. If it is concluded that variable consideration should be included in the transaction price, there are two ways the variable revenue can be estimated. So you've got the expected value method. This should be used if there are multiple possible outcomes and probabilities. And then the next method is the most likely amount method. And this should be used if there are only two possible outcomes, selecting the most probable amount. If the variable consideration changes due to new information, the adjustment is treated as a change in the transaction price and allocated to performance obligations accordingly. If the adjustment relates to previously satisfied performance obligations, it is recognized as revenue in the period of change. Additional disclosure is required when there is variable consideration, including any significant judgments made. That's step 3, determining the transaction price. Once the transaction price has been determined, the transaction price needs to be allocated to the performance obligations, which is step 4. An entity shall allocate the transaction price to each performance obligation identified in the contract on a relative standalone selling price basis. So the actual calculation for allocating the transaction price is quite straightforward. What is more complicated is actually obtaining the standalone selling prices. So if we go back to the example I was using, that software company, it might be that all elements of those contracts, they never sell separately. So they don't actually have separate selling prices themselves. So how do you then obtain selling prices, which you can then use to allocate the transaction price? Well, the standard gives a number of examples of how you can obtain the standalone selling price. So one of those is that you could look out into the market to see, are there any other companies selling similar goods or services which you could use to then benchmark the selling price. It might be that you use a cost plus margin approach. So you might know the cost of all your individual performance obligations, and then you can apply a margin to that to determine your standalone selling prices. And finally, it might be that you can obtain the standalone selling prices for certain performance obligations, but not all. And in that scenario, you can then take the transaction price, take away all the standalone selling prices, which you do know, and then what's left could be the standalone selling price for that good or service which you couldn't find a price for. So this is an area that I'd recommend if you think you're going to have contracts broken down into lots of different performance obligations. It's worth thinking about it sooner rather than later. What would the standalone selling prices be? The final step, step 5, is to actually recognise the revenue. So you either recognise the revenue over time or at a point in time. So for revenue to be recognised over time, one of 3 criteria needs to be met. So the first one is that the customer simultaneously receives and consumes the benefits provided by the entity's performance as the entity performs. So an example of this would be a commercial cleaning company which provides daily cleaning services to an office building under a 1-year contract. The customer pays a fixed monthly fee. The customer simultaneously receives and consumes the benefits of the cleaning service as it is performed, i.e. the office is cleaned daily. If another cleaning company were to take over the contract, it would not need to re-perform the cleaning work already completed. The next criteria is that the entity's performance creates or enhances an asset that the customer controls as the asset is created or enhanced. For example, in the case of a construction contract in which the customer owns the land, the revenue would be recognised over time. The third one is that the entity's performance does not create an asset with alternative use to the entity, and the entity has enforceable right to payment for performance completed to date. As an example, a software developer is contracted to create a highly customized software solution for a specific client. The software has no alternative use to the developer as it is tailored to the client's unique operations. If you go through all of these criteria and none of them are met, the entity recognizes revenue at a point in time. If an entity determines that revenue should be recognized over time, there are two different ways to calculate the stage of completion. That is the output method, which is based on measuring the value of goods or services transferred. The second is the input method, which is measuring progress based on the inputs consumed, resources used, or time elapsed. Point of time revenue is all based around when control passes. I appreciate I've covered a lot of information fairly quickly. The best way to bring this knowledge together is via an example. So in this example, we have a health club. A health club offers membership subscription packages to its customers with the following terms: an initial join-in fee, which is £500 payable upon join-in. They also get a welcome gift, so each new member receives a free cap valued at £20 upon join-in. And thirdly, the annual membership fee, which is £1,000 per year payable at the start of each year. The annual fee provides access to club facilities and exclusive member events. So, step 1, identify the contract with the customer. As I said earlier, this is the most straightforward step. The contract exists when the member signs the agreement and pays the £500 initial join-in fee. So very straightforward to identify that, so I don't need to go into any more detail. Step 2 is identify the separate performance obligations. This is probably one of the more challenging areas of the standards. So if we take the welcome gift to start with, can the customer benefit from having the hat by itself without any other resources or with any resources that they have available? So as soon as the customer receives that hat, they can benefit from having that hat. They can take it on holiday with them if they want. They can use it wherever they go. If they go to another gym, they can maybe use that hat. So clearly they can benefit from the hat without having the access to the membership facilities. So that is clearly a separate performance obligation. But what about the join-in fee? So this is where there is a bit more complexity. So with the join-in fee, it talks about in the standard, if you have to pay an initial fee upfront, that actually, if no other service or there is no other benefit from that join-in fee other than someone's name being added to a register, that would not be a separate performance obligation. And so then the join-in fee would effectively be allocated to the other performance obligations. But if the join-in fee does potentially give some type of benefit, so maybe you get a welcome pack when you join, which then provides you a detailed overview of the club, then potentially that join-in fee is a separate performance obligation. So then you would recognise that separately. There is also another part of the standard which talks about the fact that a join-in fee, if you determine that it's not a separate performance obligation, it then takes you onto this element of the standard where you consider whether it gives you a material right to purchase future services. And actually, if you have that material right to purchase future services, again, you might then state that that is a separate performance obligation. So the ICAW, they have already adopted IFRS, which has had these revenue standards in for quite a while now. And when you become a member of the ICAW, you pay an initial join-in fee, and then each year after you continue to pay your membership fee. And the ICAW, it would seem, have identified the join-in fee as a separate performance obligation. And so they are spreading the join-in fee over the expected life of an ICAW member. So if the ICAW have said that that join-in fee is a separate performance obligation, I would be inclined to also state that this is a separate performance obligation in this scenario. And then final thing was you have the membership benefits. So you effectively would have 3 performance obligations in this scenario. So step 3 is to determine the transaction price. That's quite straightforward. You have the £500 initial joining fee that you've paid, and then you've got the £1,000 annual fee you pay each year for membership. So the transaction price is £1,500. Then we get to step 4, which is allocating the transaction price to the performance obligations. So this is where you have to find out what are your standalone selling prices for each of your separate performance obligations. So you have a cap, which has a standalone selling price of £20, the membership fee is £1,000, and the joining fee is £500. So the standalone selling prices in total are £1,520, whereas the transaction price is £1,500. So clearly there is an element of discount included there, and effectively the discount then gets allocated to each of the different performance obligations, and that is based on the standalone selling prices. So the final step, step 5, is to recognise the revenue. So the cap, I believe, is quite straightforward. You almost don't even need to go through the 3 criteria that I talked about previously. Clearly, the cap you would recognise at a point in time. So as soon as the customer receives the cap, you would recognise the revenue. The membership benefits, so you would recognise that, well, if you look at the membership benefit, the customer is simultaneously receiving and consuming the benefit from having the membership to the health club. So the membership benefits you would recognise over time. So you would spread that over the year on a straight line basis each month. And the final one, the join-in fee, again, that would be recognised over time because of the customer simultaneously receiving and consuming the benefit from that. And so you would recognise that on a straight line basis over the period that the club expects its members to remain at the health club. So that might be, say, 15 years. There's a lot of judgments and estimates involved here, and it's something that you would then have to revisit at each year end to determine whether you felt that the estimate was still reasonable. So that covers off a scenario. So to finish with some implementation tips. So identifying the separate performance obligations with a contract, that does involve a lot of judgment, and it can be something that's quite difficult to get your head around. So I would recommend thinking about that element of it sooner rather than later, particularly if you have lots of different contracts with lots of different elements. Once you've gone through the process of identifying the number of performance obligations within a contract, I'd recommend getting someone else to look at it and see if they come up with the same number of performance obligations, just to kind of sense check the number of performance obligations you've identified. There are also judgments around the transaction price, and particularly when there's variable consideration. So again, think about those areas sooner rather than later. Contract modifications and variations is not an area that we had time to cover on this webinar today, and it is a bit of a complicated area. So the treatment of a contract modification depends on whether it's a separate contract or a modification to the existing contract. So if you think that you will be impacted by this, if you have a lot of changes to your contract, I would recommend looking into the standard to see what it says around this area. Finally, it will be important to consider whether there is a change in the timing of revenue recognition, which might impact any key business metrics. So could this have an impact on any employee remuneration, such as bonuses? Could there be any impact on earnouts or any impact on debt covenants? So if your revenue point does change, just take that stand back approach and think, are there any other wider implications of it? When you're preparing for this, just ensure you identify and collect all your existing contracts and any new ones up until the date of initial application. Analyze these contracts sooner rather than later to identify the impact. And it is worthwhile considering whether there should be any standardization of contracts with some customers, because if you do have lots of different contracts, then it's going to be very time consuming going through this process. But the key thing is just make sure you are preparing for this sooner rather than later.
Now let's look at the next steps. We've given a very much a general update on the key changes coming into FRS 102, but we will be providing more guidance and sector-specific updates later in the year to drill down into the specific issues likely to be faced by those sectors that are likely to be the most impacted. So do keep an eye out for those. Consider if you want to early adopt, particularly if you think the changes will have a positive impact on your financial statements and KPIs. And now over to you to start preparing.
Thank you for watching today's webinar. If you have any questions, please feel free to reach out to your key contact at Menzies, or alternatively, reach out to one of us. And good luck.